Hey there, friends. Welcome aboard. You're in the right place at the right time. This is part 2, and we're going to talk about developing a complementary strategy. In the last session, which I hope you caught, we did talk about this trade as well. We talked about the Channel 33 breakout trade and the current trade I just took. I've actually moved this to break even, so my stop loss is at 2.0773 now. It's no longer down here. And we'll see, it's either going to pull back and hit my stop loss, or it's going to chug along, or maybe go nowhere. That's false duality. When you say it's either going to do this or do that, that's false duality, right? We'll talk more about cognitive biases and how they impact our decisions in trading in the future. Obviously, it could do lots of things. It could gap up here, it could gap down here, it could gap over my break-even stop. It could sit here and range trade for 35 weeks. It could come up to my stop, miss, or my target, miss it by 1 pip, reverse, come down and stop me out at break even. There's lots of things it could do. So we don't want to get sucked into false duality. We'll talk about that in a different session. Today, we're here to talk about developing a second strategy and what type of strategy should our second strategy look like. Why is it important? The reason why it's important to develop your second strategy, and in some cases even your third, is because this is how we get the smooth equity curve, and this is how we get the sort of 45-degree angle, or nearly, that traders like to see. The only real way to do it is to diversify. And there's a myth in the markets about diversifying by market. Diversifying by market doesn't work. Let me state that another way, and you can check this on your own, as I have. And it's an empirical question. This is a data-driven question. You can use data to answer this. And the answer to the question, how do I diversify my trading, is not by trading the euro yen, the pound kiwi, the Singapore dollar against the US dollar, the yen against the Swiss franc. That's not going to work. Even trading, Apple stock, Tesla stock, options on West Texas crude oil, and trading the Hang Seng index, even that's not going to diversify. Years ago, I created an AI system. We called them neural networks or expert systems at the time, where it was predicting the 20 and the 10 moving average on the USD yen. And I was amazed and shocked at how correlated all of the world markets were. I knew this because every day I had to manually input the closing price, the high and the low, for all of the world markets. And so it was really interesting to see that, the Nikkei and the DAX are correlated, just like the pound New Zealand and the CAD Swiss are correlated. So all of these things are very, very crazy. Now, what this is all to say that the reason why we diversify is so that we can get a better equity curve. Now, you've seen, we talked about one of my coaching students and, the work that he's done developing complementary strategies. And the reason why he did that is so that he could get to the point where his equity curve was a lot more palatable. So early on, he had equity curves like this, or like this, or like this. And these simply are not feasible. For most traders, if you trade this, you're going to quit about here or here, maybe even here, depending on how, what your risk looks like. And for traders trading this, you're going to quit here, 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 or here, probably here right before it starts to ramp up. There's a funny psychology thing going on there. Even something like this is tough because you sit and you flatline for so long before you get the hop up. You flatline, most traders would probably quit around here. And then it starts to look better, but really what happens is, to get your really nice looking equity curve, you have to add several strategies and get to the point where you have all of them. In this case, he's got 3, and that allows you to see some fairly consistent results. It's not the 45-degree angle. And by the way, if you ever see a 45-degree angle on your equity curve, that is usually a martingale strategy. And what that usually means is they will fall off the cliff. We've talked about this before in other sessions. I don't want to get sidetracked, but that's really important to note. So the first strategy we talked about is this idea of, let's trade the breakout strategy. So we're waiting for a channel. We measure the channel. We wait for a third of the breakout of the channel, then a pullback, and then based on that, we go long. So in this case, the target is still 209.48. It's just the stop loss has been moved to 207.73 in this case. So if it does come back down here, it'll get stopped out. But it's gone up a little bit, and it's enough for me to say, okay, we've gone up, we've pulled back here on the wick here. Let's see what happens. Let's see if we can chug on further. So what should your second strategy look like? Well, your second strategy should look like something that is not correlated with your first strategy. So one way that you can do this is you can run a Pearson product moment correlation in your favorite spreadsheet, and like Excel or whatever, Open Office or whatever. And what you do is you plop in your daily profit and loss for strategy A, and then plop in your daily profit and loss for strategy B and run the correlation. What you want to see, what you really want to see, is something, an R equal to 0.3 or less, ideally. Might you be able to make it work with 0.4? Maybe, but really, ideally, you'd be looking at something that has a 0.3 correlation or less. Our main man, Alexander, was able to do it where he got it, really, really close to 0. So that can really help if you're able to do that. But the point is that the lower the correlation between the daily equity P&L, the daily P&L, the more likely that one's going to zig while the other one's going to zag. And that's what we need. We need to see one zigging while the other is zagging, so that we can, when one of them is in a drawdown, the other one is making profit and filling in these pullbacks or drawdowns here. We need it. We need one filling in when the other one is not pulling its weight. That's critical, right? So let's talk about a strategy today that you may use to identify trades that are going to be very different to what you would get with the Channel 33 breakouts. As we said, a Channel 33 breakout is basically an extended retracement if you're in a trend, or maybe not, maybe just you're range bound and you get a breakout. Same thing really with last kiss trades. If you like the last kiss trades in the old Naked Forex book, it's similar to Channel 33. The rules are a little bit different, and the overall statistics of the strategies are different, but basically it's the same philosophy that you're using when you use a Channel 33 breakout versus a last kiss breakout. Yeah, post the questions in the Q&A, please. Do correlations matter if systems trade different time frames? Yeah, they do. They still matter. What we're really talking about, all we're really running the correlation as I've laid out. And by the way, all this stuff is in the forum. We have videos on how to run correlations and all that. It's in the, I think it's actually in the I believe it's in the personal trading program, actually, in that course. So you should be able to go down there and see it. Just go down to the bottom where all the courses are. Naked Forex Now, go in there, and London Conference, blah, 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 blah. I believe it's in here, in this course, personal trading program. Okay, so that's where you should find it. All right, now, okay, cool. Now let's move on. So yeah, all we're really looking at is answering the question, which is, does one system profit when another system is losing money? Or does system A lose money when system B profits? Or does system B lose money when system A profits? And the answer we want to have is yes. We want that to be yes. We want one zigging, the other zagging. If you get a very high correlation, then they tend to both make money at the same time and lose money at the same time. And that's not really going to help smooth out your equity curve. All right. Again, using trading different markets is not, I repeat, is not going to diversify to the point that you want. All right. So hopefully that makes sense. So we're going to talk about strategy here that's completely different to what we looked at with Channel 33. All right. So I'm on Aussie Kiwi 1 hour chart, although I could go 15-minute or 30 or whatever. It doesn't really matter. And what I'm looking for are what are known as missed pivots, my friend. Missed pivots. So this is an old strategy, and it's actually a great mean reversion. And I'll let you decide why I've decided to use this particular currency pair. It was not chosen at random, I can tell you that much. Okay, so what we wait for is, that was almost one. Here we go, here's one. All right, this is a, no, it's not either. It's not a trade. Oh, hey now. Where is our trade at? I'm using 5 p.m. New York time close. Okay, that's what I'm using, 5 p.m. New York time close. That was also another near miss. I know we have a few because I was looking at these earlier and I saw plenty. All right, these are going hog wild. I gotta leave them alone. There's a near miss. There's a near miss. Oh, here's one. Oh, here we go. All right, we just had one on the 6th. All right, great. So what we're looking for here is our missed pivot is right here. So this is the daily pivot for the February 5th. Right. Wait. Is that February 5th or February 6th? Oh, am I looking at hold on. Am I looking at my weeklies? Oh, I'm looking at weeklies. That's okay. We can do weeklies too. Actually, that's fine. We can do weeklies. I'll do weeklies. Not a problem. Not a problem. So let's do weeklies then. I'm gonna go 4 hour though, to make it easier to see. So we've got the weekly pivots here, and what you're looking for is you're looking for the market to miss the weekly pivot and get down to either S2. Okay, so just to recap, if you're unfamiliar with pivots, so what you have with your pivots are you have the blue line right here, which is the pivot point, and this is kind of like home base. You have S1 here, which is support level 1. You have S2 here, which is support level 2, and then you have S3 down here, which is support level 3. Okay, and you actually have an S4 too, but I'm not sure if. I think it's kind of hard to see these. I've tried to make them as easy to see as possible, but they're a little bit tricky to see. Hopefully that helps a bit. So here on this week right here, what we have is we have the market came close but never hit our home base, right? And then it hit S2. So what we do is we buy when the market hit. We have 3 positions we can take, all right? So you divide, you're taking very small positions, and you're dividing them up by thirds. And sometimes you might not take a full position. So what happens is we hit S2 here, so I buy, and my take profit is this home base area here, the missed pivot, which is right there, okay? So this is S2. All right, and we're waiting for it to get up here to cash out. Now, if it gets to S3, I take an additional third position, a third of a position. So if I'm risking, 2%, then I'm risking, 0.7% on this one, 0.7% on this one. And then if we go an additional 300 pips past S3, I would have an additional one, okay? So 300 pips is going to be way down here. It depends on the pair. You might, have 200, 150, but I would have another one here. Okay. Now the stop loss is going to be calculated as 400 pips from your S3. So the stop loss goes here because sometimes it's not going to work out. Most of the time it's going to work out, but I would have my stop loss. So all of these positions are calculated on that stop loss. So when you take position 1, your risk is defined as 400 pips below the S3. So when you're buying on S2, your stop loss is all the way down here, right? So that's important to note. And then if it gets to S3, you take another position, and rarely it will go 300 pips further, but it may do that. And sometimes you got to hold these, right? Sometimes you got to hold these for a while. Now in this case, we haven't hit our target. We've got one position. We do not have the second position because we've never been down to this level. But if we had gone down there, like say today, that would be a buy down there. And we're just waiting for it to get back up to 107.45, which is the target. Okay? And that is a very, very simple reversion to the mean strategy. That's all that is. So, no, home base is the main pivot. No, the target is not. Sorry, let's be clear. This is your pivot point, and this is your target, the blue one. The green one is S1. The green one here is S2, and that one is S3. We take a position at S2. That's a first position. We take a second position at S3, and we take a third position, some number of pips away, 300, 200, whatever you want. And my stop loss is an additional 100 pips beyond that third position. Okay? And then all of those positions are targeting the exact same target, which is this one right here, which is the home base, which is basically your pivot point. So for every pivot, you'll have a pivot point, an S2, S3, S4, and in this case, we actually have an S1, S2, S3, and then we have an S4. And you'll have an R1, R2, R3, and R4 as well, right? So let's see if we can find a sell example, because we just had a buy here. Let's see if we can find a sell. I think we've already hit. Have we hit the pivot this week? No, we haven't. We have not hit the pivot this week. So potentially there could be a trade this week, because here's our weekly pivot. We haven't hit it. But we won't know that we have a trade unless we get up here. The only trade we could possibly have this week would be a sell, and that would be if price went from where it is right now all the way up to R2, which is up here around 107.84, right? If it comes down and hits our pivot, we wouldn't have a trade this week. Does that make sense? All good, Mark? Yeah, all good. Sorry for the confusion. All right, I want to give you another example so we can see. I want to see if we can hit R2. Get an R2 example here. Da-da-da-da. See, this one went to S1. It missed the pivot, and it went to S1. It never went to S2, so it didn't trigger the trade, because it never went to S2 down here, and instead it hit S1, and then boom, it came back to home base on this candle right here. See that? So there was no trade this week, unfortunately. Okay, let's see if we can find. Ooh, here we go. We did hit it there, unfortunately. Let's see here. Let's find a nice move higher. Here's one here. So did everyone see this one right here? Here's another trade right here. This is a buy again. Here's your home base. You never hit it that week. Come down. Doesn't really matter. It can happen as the week is unfolding. You could have it hit S2 here during the week before the week is over, before the weekly candle closes. But this did in fact hit the second week here. So you go long here, and you can see blammo. Ooh, maybe you don't get hit there. Oh no. Oh no. Oh, okay. Then you get cashed out all the way over here, November. That's end of October, I think, actually. And when was that taken? When was that trade taken? Oh, you just missed it. Oh, that would be painful. This trade was taken on July. Holy cow. And that's October. We can do this on daily too. We'll look at some daily examples too. This one is a missed pivot. Okay, here you go. Here you go. So here's home base right here. This is a sell. So we go up. We hit resistance 1, R1. We hit R2. That is where we take our first trade. We sell. And then, and again, all the risk is calculated on, this is R3. So R3, if we go 200 pips higher, let's say, so 300 pips from R3 is where we would calculate our stop loss. So you're having you're taking a really small position here, and then I don't think it gets to R3, does it? No, it comes back down and hits home base right here a couple days later. Sorry, a couple weeks later. Here's another one right here. Here's a missed one right here. You hit, this is R2. So here, we'll put our home base in here. This is your home base. You hit R2 right here. So you sell right there. I think you're going to hit R3 as well. No, you're not going to hit R3. And instead, you end up hitting home base when? There. Right there in October, end of September. Okay? All right. Now, let's talk about dailies. Let's just get rid of all of our objects and we'll go dailies here. Delete. Delete, delete, delete. Okay. Let's go with missed pivot daily. All right, here we go. All right. So we have a missed pivot here on June 27th. And we did hit S2 here on this wick. We go long and we cash out right here. Just double check, make sure I'm right. Maybe, maybe not. Maybe you actually have to wait, which would be unfortunate. To be fair, I usually go a little bit, like I make it a little bit easier, kind of like my targets on support resistance. Especially if I've been in it for a long time, I would go a little bit lower than the pivot in a buy case and a little bit higher in a sell case. But, ooh, let's see, where's our, so we hit S, this is S2, S3, I believe is down here. So did we touch this? That's the question. Before we went up. No, we did not touch that one. All right. So does this make sense, guys? Is this all clear on what we're looking at here? Let's see. When taking longer term trades, it's important to use a broker with any special characteristics. Look, you can use, if you can get a Sharia account, which is swap free, you can do that. Obviously, you want to look at what the swap is on the pairs. I would not trade this on all pairs. I think there's some pairs that are better than others. And there's a reason why I'm putting, this chart up there. So, it just depends on your tolerance, to pay swap like this. Now, you're not going to have such a problem when you look at lower time frame trades. So here's an example right here. Here's a missed pivot right here. You buy right here, and then you have to wait forever for it to come up. Let's go to the current where we're at right now. We haven't hit it yet today. So there's our home base pivot today. So there's a possibility of a trade today. We actually did hit it yesterday. So there's no trade there. We also hit it the previous day. We hit it this day. As you do most days, you mostly hit it. Here's one. So this was the 5th of Feb. I think we already looked at that one, didn't we? Yeah, so you hit S2 here. And that was this spot right there. And we haven't hit that. We haven't hit that target yet. Okay. I think we looked at a weekly pivot that was similar to that one. Now let's talk about another system that you might use. I would probably use this on the 30-minute. That's how this is what I like it for. And basically what you're looking for is you're looking for it to hit S3 or R3 or S3. And I like a double top formation. Some traders like to use an indicator with divergence on this one. It doesn't matter if you hit home base, but basically what you're saying is, the market's stretched. So this is like a trade that you would take. I got to get rid of this. This is going to mess me up. So let's back this up. And what we're looking for here is a day where we hit R3 or S3. And no, missed it there. And again, it doesn't matter if it's hit home base or not. That doesn't matter. Oh, missed it again. It takes a pretty big move, or what you have is a really tight range the previous day to get one of these, unfortunately. It's pretty rare, but you get, it may, so the missed pivot thing, I like it on the pairs that tend to revert to the mean, whereas with this last system, you can use it with a normal pair like a euro or euro yen or something like that. Yeah, it's not giving us. The problem is this pair tends to revert more than most pairs. And so that's why it's really good with the missed pivot, but it doesn't necessarily mean that we get out far enough for the S3 or R3. You'd probably be better off looking at yen pairs for that. All right, let's talk about one more. I'm gonna pull up another one here, and we'll use pound. We'll use 5-minute chart. We'll use our 8-hour, and then what we're gonna do is we're gonna back this bad boy up. Okay, get lots of data in here so we can. And this is another reversion to the mean. What you do is you wait for the market to get really far away from this moving average. And once it's away from it for many, many, many candles, you trade back to the moving average. So like a lot of what you'll see is that the market tends to stick around the 800 simple. And then what you want to see is you want to see the market get away from it for like let's see here. How many candles was it from here to here? Is that no. Yeah, 281 candles, 224 candles. So when you've been away from the 800 for a long time, say over 250 candles or something like that, then what was this one? Wow. It's 100, 140, and then boom, it hits it again. So it takes, here's a good one. Look at this one. Here's a good one. So this is 96, 250, yeah, maybe 200 would get you in here perhaps. Yeah, you need a really nice one. Let me show you a good one. Okay, we might be in one right now actually. Yeah, so now I like it on the lower time frames because you get more trades, right? Trading on the 4-hour or whatever, you're gonna be waiting a while. It does, not to say it doesn't work, but this is something for you to test as well. So we've been away from the 800 for how long? Oh, 300 candles. So this is pretty good idea that we could sell. Sometimes what we do is we sell when it starts to bend down. It looks like it's going to go. You take a sell, goes up here, starts bending down. You take another one up here, starts falling. You take another one, right? You're taking really small positions like most mean reversion strategies. And so now remember, your target is also moving. So we originally, on this sell, for example, I don't think that was 200 candles, all right? That is. That's 120. 150 would be over here. 200 is here. Yeah. Yeah, so your target, was here, and now it's a little bit higher up here. But you get the idea, right? So you're just trading back to the 800, especially when it gets far away. You could throw like a really wide Bollinger Band or something, but it's not really going to help you as much as counting the candles. Yep, so this is pretty good too. This is an old one. I find it hard to hold on to winning trades during retracements. I prefer to close my positions overnight before New York close. So what you need to do is focus on execution. We'll talk about that in one of our later workshop sessions. But you need it's what often happens with traders is we look at the P&L instead of are we executing. And what you want to do is shift all your focus and all of your attention and precision on execution, and practice is on execution instead of where is the P&L. For non-correlated systems, isn't it as easy as picking a trend following on a mean reversion ranging type system? Yes. In fact, that's exactly what one of our students is doing in here. He's actually doing, actually most of his conversations are on my phone. We've been going back and forth. But what he's doing is he's basically trading a trend following system and a system where he basically trades boxes with a naked price action pattern inside the boxes. And that's it. That's his diversification. Yeah, that's right. what I'm trying to do is give you a little bit of a different approach. So mean reversion isn't something that a lot of traders trade. And the other aspect is the breakouts too. Breakouts, a lot of traders can't consider breakouts, or they just think of a box breakout, right? So that's why I wanted to share with you Channel 33 breakout, because that's a bit different. May spark some thoughts, as is the mean reversion strategies with the pivots or the moving average. Yeah, which is a really long-term, slow moving average, the 800. And you may see this on, let's go Aussie. What's Aussie 5-minute look like? So I'm going to put my moving average 800 simple and see. Oh, look at that. Yeah, one of the problems is that you got to take multiple positions, and you can see this is what happens when you get a really sharp move quickly. What that often means is that you will end up hitting the 800 simple, and then these trades over here underwater. That's why you got to keep taking multiple positions, right? Or if you get a really sharp move, don't take any. So sometimes, like for example, Bitcoin. Okay, Bitcoin would be a great example of this. So if let's say we were trading Bitcoin on the 1 hour, and we wanted to this chart is awesome. I've been trading the 1 minute Bitcoin chart. It's been awesome. Okay, so it's just too funny. All right. Okay, so like here we go. Here's your 1 hour Bitcoin chart. I don't think that trading to the 800 is going to work, right? Because I think by the time price gets to the 800 is going to be up here. So you want to make sure that if you're going to trade this to the 800, that you're not in some sort of wild trend. You need sort of, you know what I mean? Like, you don't want to see some really sharp moves. And, you know, like here's a great example. So then we had some really big moves here. So yeah, it does get back to the 800, but like it gets back to the 800 here, not down here. So roaring, raging trend, not so good, right? So I would steer clear of this with gold, silver, Bitcoin, S&P 500 at the moment, because it is going to hit the 800, but the problem is the 800 is going to be up here at 71,000. That's going to be the problem. So yeah. All right. Okay, so let's talk about what else. So as we talked about before, if you guys are interested in getting your trading blueprint call, the reason we do this is because we know that some of you, not all of you, but some of you may be interested in joining the personal trading or the one-on-one coaching. And we're luckily in a position where we don't really, we have a lot of, we can be picky, basically, let's say. We can be picky, so we don't have to take anyone. We usually open up 2 slots a month as other traders graduate. And so if you would like to get your trading blueprint, and if you're a good match for us, we may offer an invitation. You can click the link and book your call with myself or Eddie, and we'll talk about your trading and what we would do in your situation, and whether or not you would be a good fit to join our group. It's a small group, so there's that. For that, some of you may be interested in that. Some of you may not. Most of you may not, and most of you, obviously, it's not going to be a good fit. But for some of you, it may be. All right, let's talk about the next thing that I want to talk about here on my list for today, which is how should it differ? Okay, what does your second strategy look like? It should look totally different. It should differ from your original strategy by the correlation. Remember, with correlations, it's important to note that you square the correlation to get the shared variance. So if you've got a correlation of 0.3 between your daily profit and loss on your 2 strategies, that means that 9%, there's 9% shared variance. So as system A makes money, system B also makes money 9% of the time. So that's what you want. You want something like that. Basically, you want it under 15%. So if you have 0.4, you're going to have 16% shared variance. But really what you want to see is, can we get it under 10? Can we get it under 10% shared variance? So we We want mostly one zigging while the other one's zagging. So that's really critical, right? All right. How do you know if it's good enough to trade? So there's a lot. Okay. In our next session, which is going to be tomorrow, I know it's evening for many of you. It's morning time for me, but the next session will be tomorrow. We're going to talk about how you can set yourself up so that you don't hit your terrible drawdowns and what you can do. And we're also going to talk about ways that you can maximize and improve your strategies. So you might have a really good strategy that you like, but it's not quite as profitable as you would like. So there are things you can do to improve that, and we're going to talk about that in Workshop 3. But you know if it's good enough to trade if you essentially have a win rate you're happy with and an equity curve that looks good when it's combined with your prior system. So let me state that another way because it's really important. You may actually have a system that looks okay and you're like, it's borderline. I may want to trade it. I may not want to trade it. I wish it was a little bit better. But here's the thing. When you add that system to your second system, the combination of the two actually looks much, much better. It's the old adage, like, a group of people can, 2 people can do, 300% of the work that one person can do, right? It's the same thing with trading systems. You may have a trading system that you give like a C+. You're like, yeah, I guess it's good enough to trade live, but I really wish it was better. And then as soon as you add another C+ system to that, and you look at that combined equity curve, boom, you got something really good. It's amazing how much better your equity curves look when you have a couple of like subpar systems. Like they're okay on their own. And in fact, if you look at the automated trading guys that trade the robots, the EAs and automated systems, that's what they do. They have 20, 30, 40, 60 different strategies that are all like, I don't know about that. Like if you were just to choose one of those, you'd say, nah, I don't think so. I'm not going to mess with that. But because they have so many of them, their equity curves go gangbusters. And that's really what it's all about for them. It really becomes the focused energy of all those strategies really ramp up the equity curve. All right. So it may look pretty poor, but as soon as you add a second and even a third strategy, you're going to see something really cool looking. And the way to do that, obviously, is you sort. So when you have your back testing data, you sort by closing date and time. So you sort all your obviously you want to back test during the same time period, and you sort all of your trades. So you import all of your system trades for system A, system B, system C, put them in there, and then you sort all the transactions in the order of closing date and time. So that way, that's when the profit or the loss is booked, right? All right. Will you give up your trading strategy? Here's how to know. Okay. The way that you know you're going to give up your trading strategy, and we're going to talk a lot about how to massage this in our next call, in our next workshop, but I'll show you right now because some of you may not have seen this. What you do is you use, wait, what? It's right here, right? Yeah, this is it. Okay. So what you want to do is you want to use the handy dandy risk calculator. I've got a video here on how to use it. Be quiet. And essentially, now in the next workshop, we're going to talk about more sophisticated styles of risk management, but most traders are using what's called the fixed fractional. So they're risking 1% per trade or maybe 2% per trade. So what you would do is you go, well, my win rate is 56%. So you put that in here. My risk to reward or reward to risk ratio is 1.35, we'll say. And I'm going to risk 2% per trade over the next 10,000 trades. I recommend you put 10,000 in here for very good reasons. Am I going to hit a drawdown level of 15%? So 56% of the time I win. I'm making $1,350 on my winners. I'm losing $1,000 on my winners. I'm losing $1,000 on my losers. I'm risking 2% of my account. I'm looking over the next 10,000 trades. Will I have a 15% drawdown? And the answer is bingo, 100% yes. In fact, every time I hit this button, it's recalculating it. Okay, maybe what if I say a 25? Let's say I can withstand a 25% drawdown. Well, I still have 3 out of 4 times it's going to hit. So this doesn't work. This does not work. So I've got to reduce my risk. So I go 1%. If I'm risking 1%, will I have a 25% drawdown? I've got it down to about 1% or a 0.5% likelihood of, about 99.5% likelihood that I will avoid my drawdown amount. So this is how we know if we're going to quit. Traders quit strategies because of this. This is the reason. Not because they're making too much money or because they have too many Lamborghinis, not because, it gets expensive mincing with models or anything like that. The reason why they quit is because the drawdown, it gets to the point where they just cannot stomach it. And so how do we avoid this? It's all about risk. Now we're going to talk about how to improve your strategy and how to modify your risk so that you can achieve the levels that you're looking for. But that's going to come in the next session. Okay? That'll be what we talk about in the next session. What else do we have here? Oh yeah, here we go. So that's how you know if you're going to give up on your trading strategy. This is at fxjake.com/risk, by the way. So we'll copy that. Here you go. Put that in there with the link to the blueprint. All right. Okay. So the last thing we have on our list here is what is the number one method for improving your trading strategy? Does anybody know? What is your guess? What is the number one method? Standard deviation values? You can get those from a spreadsheet, John. If you dump your data into the spreadsheet, it'll give you your standard deviation. What you want to do here is it's called a Pearson product moment correlation. That's what the correlation is. It's usually just referred to as a correlation coefficient, but it's available like in Excel, probably in OpenOffice. I don't know if anyone uses OpenOffice, but they have a spreadsheet as well. OpenOffice is like a free version of Microsoft's suite stuff, like Outlook and Excel and stuff. It's probably in there as well. So you run a Pearson product moment correlation, and that's how you'll get your R value. And again, what you're doing is you're putting in your daily, profit and loss. So, for each one. So this one made $340. System A lost $1,200. System A loses $1,009. System B makes $580. System A makes $230. System B loses 123. That's what you're doing is you're running a correlation on these two columns here, and then that spits out an R value. You square it, and that's how you get your shared variance, and that's going to tell you we're really looking for something under 0.3, definitely under 0.4 if you can, like 0.38 or 9 could possibly work, but we really want it as low as possible. Like I said, Alexander was able to get to basically 0. It was like 0.07 or something, like under 0.1, which is pretty outstanding, pretty good. No, the two columns are for the same day. So you might have multiple trades. Yeah, so what you want to do is have your daily P&L here. You'll get daily P&L from Forex Tester or Naked Dash Markets or whatever software you're using. But yeah, your P&L is your daily P&L. So if you have a daily P&L of negative $123 on System B and a daily P&L of $230 positive on System A, that's what you're looking at, your daily P&L, and you're basically running a correlation on those two. There's a video in the forum on it if you guys want to see it. All right. Yeah, so the way that the best way to improve your strategy, and here it is, dun, 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 and this is the big reveal for what we're going to talk about in our next session. The way you improve your strategy is, and this is going to be the cliffhanger, see you soon, is you modify your exit rules. And that, my friends, is where nobody looks. Everybody looks at the entry, get a better signal, get a better edge or whatever. It all comes down to, and all of the one-on-one coaching students can attest to this, it really does come down to a lot of work on your exit rules. That's where the gold is, and that's what we're going to talk about in our next workshop. Thanks so much for spending time here. If you'd like to book your call, you can go to the link in the chat there, and we will see you in the next call.